Kelly Slott, CEO and owner of California Wealth Advisors. I am an author and a radio show host, as many of you know. So welcome to our presentation tonight. Again, we're going to have a lot of these different kinds of presentations. I'm going to talk about them towards the end. On the table here in front of all of you in the room, we do have the invitations for the upcoming webinars we will have. But tonight we have Mr. Chris Ball from Allianz. He's going to talk about variable annuities to all of us, educate on all of that. He's got a big smile on his face, which is great. I haven't had an annuity speaker in a very long time, so I'm thrilled that Chris is here talking with us and educating us on variable annuities. So thank you, Chris. I'll introduce him in a minute. People in the room, remember, I need you to fill out these forms here, or blank space if you have a question, because people on Zoom cannot hear your question. So please don't just throw out a question because they can't hear you and then it's dead silence for them, and that's no fun for them. So hand these to Hannah or me during the webinar today, and we will answer questions at the end. So everybody on Zoom, if you have a question, by all means, type it in for us. We'll be writing those down. We'll be answering those questions towards the end. And know that if I don't answer your question, it's because I feel like we answered it already, or we need to perhaps take it offline and we will get back to you. Okay. Okay, let's get started. Again, this is my foundation, Building Foundations for Financial Wealth series. I do have a number of these, like I mentioned earlier, that I do. I talk about a lot of different products, a lot of different topics we talk about. Coming up, and I'll mention these again later, we have 1031 exchanges we're going to talk about on May 8th. Then we have institutional real estate we're going to talk about. That one's on May 29th. And then we have a number of different ones in for the rest of the year. I think we're pretty much booked the rest of the year. We have a lot the rest of the year. We have our summer party coming up. So those of you that live in Santa Barbara or want to come in from out of town, I have a lot of people that live out of town, but a lot of people like to drive in for our summer parties. And as you all know in here, I have many in here. I think all of you in here were at our Christmas party, which was absolutely fantastic. Yeah, it was fun. Okay, so our Building Foundations for Financial Wealth series. Again, I like to educate people on a lot of different products, a lot of different topics that we talk about. My radio show, of course, goes over investing in general and what to look out for and different things that are happening in the world timely wise. I do with my co-host, but these are more specific webinars that I do. Again, we're going to talk about variable annuities tonight. The other webinars coming up will have different topics. Okay, again, yes, I do have my radio show. For those of you not familiar with it, 1070 on KNX, and I'm also on the Patriot 1150. Those are both AM stations. So listen to those. I think that's a great way. If you don't know me, if those of you on the Zoom meeting today, if you don't know me very well, listen to the Zoom meetings. I think those are a great way to get to know me, what I think, how I do things, because I do things a little different than most advisors. Again, I wrote my book, The Great Retirement Mystery. Got one right here. How to avoid the 6 biggest blunders. I think a lot of people I see make a lot of blunders. They don't realize they're making blunders, but they are. Perhaps they're listening to their neighbor. They're listening to their best friend's sister. And while they might be very well-meaning, they might not know enough about their whole financial picture to really give them a good idea of investing and what's good for them, what's not good for them. So that's one of the big blunders. There's 5 more in there. Many more, of course, than that, but make sure that you're doing the right thing for you and you actually have a portfolio that's built for you specifically. So I'm going to talk about my private client process just to educate you a little bit on all the things that we do. So I'm going to shut this down and I'm going to bring over this so I can draw for everyone. Okay, so it says on there, I'm just going to redraw what's on there so you guys can kind of follow along here. So it says financial director. So that's California Wealth Advisors, me as the financial director in your entire financial house, because as your financial house, you have much more to look at than just your investment planning dollars, which is this part up here, which we will go into a little bit later today. In a little bit. So investment planning certainly is important. As your financial director, I'm also going to look at other things. I'm going to look over here at risk management. So I have that on the screen here, you guys can see. So risk management, what kind of risk do you have in your portfolio? Do you have the correct insurance? Do you have umbrella policies that cover you if you get sued on a rental property? Are your assets titled correctly? Again, a rental property that you might have If it's in your and your spouse's name and you get sued, they could sue you for all of your assets, not just that particular rental property. And I have a lot of clients that have rental properties that don't have them titled correctly, or they're in the name of the trust. They really need to be set up differently than that. So we want to protect you. We want to protect your assets. So risk is where we look, because we're all living our life right here, right? And going along just fine. But unfortunately, life can throw barbs at us, and it can happen in a split second. Again, getting sued could be one of them. Divorce unfortunately happens. Health issues, certainly. So health issues can help, G-A-L-T-H, health issues can affect all of us. Long-term care is important. I have many of my clients are very concerned about long-term care. They don't want to be a burden to their family. So these are the risk things we look at. Social Security is another one we look at for a lot of folks as well, to make sure that they're taking it at the right time. So what kind of risk do you have in your entire portfolio? So there's a lot more than this that we look at, but that's part of it. Then we look down here, it's your estate planning. So what kind of estate planning documents do you have? Do you have a trust? Has it been updated at all in the last year or 2 or 3? If it's 10 or 20 years old, your trust, that might not be what you really want. It might be too old, because where you want your assets to go, as well as tax laws change. So we look here at medical powers of attorney. We look at powers of attorney, certainly. We look again at how your assets are titled. Make sure your assets are titled correctly. So these are all the things we look at for the estate planning side. Then we create the family office over here, or we also call this the vault, family office. This is where we put all of your important documents. So if you have estate planning documents, if you have umbrella policies, your investment dollars, your statements will go over here. I have a lot of clients that love to travel. And sometimes people give me, or a lot of times people give me their passports to go in there, because if they're traveling and they lose their passport, they can just call us and we can send them a copy of their passport. And I had a client in Spain last year, and she was pickpocketed, unfortunately, with her passport. So she was, knowledgeable enough to call us, and we sent her a passport, and it saved her probably 2 weeks of staying in Spain that she didn't want to be there necessarily. So the family office, or the vault, we call it. We also do a once-a-year balance sheet for you that puts all of your assets on one page. Again, any rental properties you have, investment dollars you have, all your insurance items go there. It's a great place to tell your beneficiaries where to go if you have any issues. If you end up in the hospital or something, and your loved ones can know to come to us, and we can give them the right kind of documents they might need. So the family office, or the vault, I think, is a really important part of your entire financial house. As you can see here, we're looking at your entire financial house. So of course, we're looking at your investment dollars too. That's what most financial advisors are only going to look at. So we're looking at your investment dollars, what to do with those, how to have the best benefit you. A lot of different ways, certainly, of investing. I'm going to talk about that in a minute. So Hannah, you can take that back. So the private client process is exclusive to my clients. I don't offer that to everyone, but if that's something of interest to you, obviously there's a cost for that, because we're doing a lot more than just investing your investment dollars. Okay, let's move on here. Can we go to the next slide? Okay, so there are key components to investing. For those of you new to me, you need to have, in my view, a plan, a specific plan for you that's tailor-made to you, because everybody in this room, everybody on Zoom now, is different with what they need. So make sure that your plan is designed specifically for you. And that's what we specialize in doing at California Wealth Advisors. We really do. We really take into account your time frame, your risk tolerance, what you need out of the portfolio. Maybe you need to have maximum growth to leave more to your heirs. Maybe you need to have income created off of your portfolio to help pay for when you retire, replace that paycheck. We like to call it a paycheck that we replace that with. You need to have diversification in your portfolio too. You've got to not have all your assets in one thing. In my view, in my many years of doing this, I think it's way better when you're diversified. So having money in the market, it can be fine, but looking at alternatives and safe money as well. And I came up with our mass proprietary process years ago to help people kind of understand how investing works. So this is the top part of my private client process. That's the investment dollars I showed you a minute ago. So M is the market, stocks, bonds, mutual funds. Yes, this is traded. It goes up and down. That's why I have it red, because it's going to be risky, right? Yes, you can create growth out of it. Yes, you can create income off of it as well. Wonderful place to go, but just know the risks that you have there. Then we look at the alternative side. That's the light blue side here. I'm talking about real estate programs. I'm talking about private places. I'm talking about oil and gas programs to get tax write-offs or tax benefits from those. So the alternative space is a wonderful place to go. Again, I'm going to have more seminars on 1031 exchanges and opportunity zones that will be for people that really need to have some tax advantages built into their portfolios too. So if that's of interest to you, let us know, and we will let you know when those seminars are. Then we look at the safe section. That's cash, CDs, fixed annuities, life insurance, long-term care. If you want to have guarantees in your portfolio, you want to have some downside protection, perhaps. Chris is going to talk about that in a minute. But we like to have some kind of secure investments in your entire portfolio house as well. So that's where we go with that. So as you can see, we do a wide range of things. Our private client process, our mass proprietary process here, to really help people understand investing, to help them diversify their portfolio, make sure that their portfolio is specific to them. Okay. All right. So with that, I am going to introduce Chris Ball. He's going to talk about variable annuities tonight. There are a lot of benefits to variable annuities. They do have some downside protection, some buffers, some income streams that you can get from them. So I'm going to have him come up. And then at the end, I will answer some questions. So those of you in the room, write your questions on the little papers I gave you earlier. Those of you on Zoom, please type them in. And I have an assistant writing down your questions too. And we'll get some questions at the end. So with that, let me bring up Chris Ball. Thank you, Chris. All right.
What a great warm welcome. Thank you very much. I've been doing this role, retirement consultant role, for the last 16 years. I first covered the Pacific Northwest, Oregon, Washington, Idaho, and Alaska, moved down to California, and of the thousands of advisors I worked for back in the Pac Northwest, or the thousands of advisors I work with today, I have to tell you what Kelly does is extremely unique, especially her and her amazing team. And it's not just the way she's able to develop return or generate returns while reducing your risk. It's not just the outstanding service that her and her team provides. What's really important is what she's doing today. She's taking the time to energize you, educate you, and empower you on different ways to address your investment portfolio, whether it's taking care of risk, handling your portfolio, teaching about that family office option. It's absolutely rare, but absolutely outstanding. So it's an honor to be here with you guys today. And Kelly, it's an honor to be presenting with you as well. So listen, you guys, my presentation is on annuities. And before I do a deep dive into your selections for annuities, I first want to discuss some of the risks, or I should say the main risks that retirees and pre-retirees face. And we're going to demonstrate how annuities can help solve those risks. So when it comes to retirement, we ran a few different surveys. And what was really an overarching theme is that pre-retirees and retirees all were very uncomfortable with where they see the market and how where they see the market going and their ability to handle and maintain their nest egg for future spending resources. And the stats we actually pulled up is 68% understand they need some type of financial product that helps with market loss. 48% are understanding that they do need to probably sacrifice some loss, provide some downside protection. So now when we do a bigger deep dive into this, what we can see is that 59% of pre-retirees surveyed and retirees surveyed, 59% are absolutely certain and convinced that the current economic environment and future economic environment will erode their nest egg and jeopardize their ability to have reliable, predictable cash flow in retirement. However, 66% aren't getting into the market because they're too scared, although they do understand that there is a need to have sufficient returns to overcome their spending needs. So now moving forward, I want to just address one of the major threats that pre-retirees and retirees face, and that's inflation. A lot of people forget the math that if we have an inflationary rate of anywhere from 2 to 3%, in 24 years, that will double. So if you're a 60-year-old by age 84, all of the things you purchase, whether it's their bananas, their gas, your premiums, they will significantly double over time. And what we know about today is inflation just isn't 2 or 3%. We get core inflation rates of anywhere from 6 to 7, most likely higher. So let's take a look at it in the highest inflationary period. What I did is I did a deep dive into when we've had the highest amounts of inflation. So I pulled data back to 1924, 100 years ago. How many of you in this room were living in the 1970s? And you remember the cost of living? Yeah, most everybody here in this room. Surprisingly, think about yourself had you retired in 1970. 5.7% inflation, relatively high, right? And then it dips down to 4.4, 3.2. So now all of a sudden, everything you purchase and use day in, day out just got a lot cheaper. So you probably will adjust your spending. Maybe your lifestyle gets more enhanced, but next thing you know, over the next 2 years, that inflationary rate 4x's. So everything you've been purchasing just got 4 times more expensive. You definitely have to change your spending habits. And from an investment standpoint, as your advisor, Kelly really has to start making changes with your portfolio if you're spending more to cover those inflationary costs. So what's causing major increases in inflation, or where are we seeing inflation eat into people's portfolios? If I look at inflation dating back to 2013, so basically the last 10 years, we can see that inflation ate purchasing power by 30%, so roughly 3% each year. The good news is that workers' earnings and income kept up with that pace by 42%. But the big hurdle that Americans have to face is the increased inflationary rate of healthcare. As you can see, 78% to 47%, drastically outpacing just CPI inflation. So we understand that in order to overcome inflation, we can't go too conservative. If we know inflation can range anywhere from 3 to 7%, buying that CD that gives you a 3 to 4% yield just isn't going to cut it. We can't rely on that. Nor can we rely on a portfolio filled with fixed income or bonds, which are going to generate anywhere from 3 to 5%. We really need some drivers inside of our portfolio that can help us exceed inflation. So annuities do a couple different things. They help you address inflation risk, and I'll address more on that momentarily. So now let's look at volatility risk. And if you're a pre-retiree, volatility should be your friend, right? If we're adding money to our 401ks and our defined contribution plans, we're actually buying equities at a discount. And then when the market starts to correct, the growth and the multiples of that growth accelerate for us. So adding money to our portfolios is a great thing in terms of volatility because we're buying equities at a discount. And then when the market returns, we have a significant amount of compounding and growth. But one of the challenges with volatility is that it jeopardizes our ability to retire on time and stay retired. So stick with me, you guys. I created a couple different models for you, or 3 different models for you. I've got a client sample. His name is James. He's age 60. He's a good saver, you guys. He's got $1 million. In scenario 1, he gets 6% compounding interest every single year. Scenario 2, James starts out in an up market, followed by a down market, 27, 9%, 7, and -15. Scenario 3, I just inverted it, you guys. He starts out in a down market, and it works its way to the top. By a show of hands, which portfolio is the best for James while he's accumulating money? Which one do you think is the best? First one, any other guesses?
3.
Guys, I've tricked you. They're all the same. It's all a 6% rate of return. So even though James invested in a down market and up market, it all averaged out the same, right? So when we're accumulating assets, it's not a bad thing to have market pullbacks and contractions. The point is we stay invested. That's why we need a financial advisor to take the behavioral investing out and keep you on the course. But let's throw a monkey wrench into James's portfolios. Let's have James pull 5% off of his $1 million portfolio. So he's pulling $50,000 out each year. Let's also assume he's up against 3.5% inflation. Which portfolio do you think of James will be the best by providing him the longest amount of cash flow. Any guesses? I'm not tricking you this time, don't worry.
There is a winner.
Yeah, there is a winner. Let's take a look, you guys. So that 6% compounding rate of return did a good job, right? He's 60. It helped him go to age 89 before he ran out of money. Not bad. That's pretty successful. Let's take a look at the portfolio where he started in an up market. This is a major success. From a financial planning standpoint, this is a win. This got him to age 96. Let's take a look at what happened when James pulled out in a down market. Really significant delta between all those different variables. You guys, the takeaway from this is I want you to know that James didn't work harder or he didn't work less in any of these portfolios. And there was no intelligence difference between all the portfolios. They were invested in all the same things. There's no differentiator other than James retired in a down market or an up market or a sideways market. So the reason we purchase annuities is to help make sure you've got protection regardless of where the market's at. So when it comes to annuities, you have basically three types. You've got your fixed annuities that stay the same and grow tax deferred. They're very valuable resources, but your expected rate of returns varies depending on where interest rates are at, anywhere from 2 to 5%. The next family of annuities that you have access to are fixed index, where you have 100% downside protection, but you're capped on your returns, and those expected rate of returns can vary anywhere from 5 to 8%. And then you've got this family of variable annuities, where there's no downside protection, but there's also unlimited upside, right? So the challenge with these contracts is that oftentimes when you purchase them, they may be the solution for that specific market cycle. Like in 2022, when the market's contracting 16%, you might have thought, hey, a fixed annuity that pays me 3% is a great idea. But the challenge is when the market comes back, you're stuck earning that percentage. Conversely, in a variable annuity, it's great while markets are thriving and expanding. Once the market starts contracting, you're seeing losses in your portfolio and you're stuck inside of it, kind of handcuffed to it. So in 2014, we decided to combine all three annuities into one, and we call it a buffered annuity. Simply put, we help you buffer out losses each year, and you can control those buffers. Allow me to explain. If you're a client who knows you need to overcome inflation and you understand that that's an enemy to your portfolio and you need to drive returns, so you need equity exposure, what we allow you to do is to choose amongst 5 different asset classes. That includes the S&P 500, a measurement of all the 500 largest, not the most successful, but the largest domestic companies in the United States. The other investment we give you access to is the Russell 2000, the smallest growth companies in the United States. Next is the NASDAQ, which is your tech and companies. Next is your international, and then finally emerging markets. So you can invest in amongst all those asset classes, but you control your downside protection. For example, every year you can choose a 10% buffer, a 20% buffer, a 30% buffer, or a 100% buffer. Allow me to explain. If you choose a 20% buffer and the market, meaning the S&P, is down by 22%, you didn't lose 22. I buffered out the first 20% in losses, so you only lost 2%. The bigger the buffer, the smaller the downside. So for example, if you only want to buffer out a potential 10% in losses, I'll allow you an upside of 30. If you want to buffer out 20% in losses each year, the max upside is 20. If you want to buffer out 30% of potential losses each year, the upside is 10. But if you want to buffer out 100% of your losses, the upside is 5. So 3 times per year, you can change your buffer up and down. So once again, we allow you full access to equity markets amongst a number of different asset classes, but you control your downside protection. Because the challenge with investing today is you've got equities or you've got your safe money options. And if you got too many safe money options, you expose yourself to inflationary risk. But if you have too much equity, you expose yourself to sequence of returns risk, like I explained, that James suffered from, and also volatility risk. Now we're giving you the best of both worlds by allowing you access to protected equity and you control the downside. Now, some of you may be thinking, Chris, I'm later in life. I've already got my equity investments taken care of. I'm looking for something that's really dynamic, and I'm kind of a conservative investor. We offer something called a dual direction buffer. Allow me to explain. If the market is between 0 and -30, so anything in between 0 and -30, we give you a 5.5% rate of return. So even in a negative market, we'll generate a 5.5% return. You've got a -20 buffer. So if the market returns anything between -20 and positive or 0, we give you a 7.5% rate of return. If the market performs anything -10 to positive, basically 0, we give you a 10% rate of return. So we've got really creative ways to generate a positive return even in down markets. So the purpose of annuities is to solve as many risks as possible. And the main risk that I tend to see being used today is income risk, or basically allowing you to have a personal pension. Much like my slide on James, like I mentioned earlier, James isn't in control of what the market does when he retires. He may be lucky and retire where you see the purple, but he also may retire what's in the green. So what we allow you to do is while you're invested, controlling your buffers on the downside, maintain your equity exposure, is we have a personal pension on the back end. For example, if James, age 60, invests with Allianz and decides to turn on his cash flow and retire at age 65, we'll give him 8% for life. So he can pull 8% off his portfolio, and no matter what's happening in the marketplace, instead of showing a 0 balance at 36 years, it will show he'll always have a balance for the life of the policy for as long as he lives. So once again, the variable annuity, the new type of variable annuity that Kelly offers, allows you as much safety as you want for as much equity exposure as you want, and you can also build in a personal pension. Now, stick with me, you guys. What's great about annuities today is, well, let me ask you by a quick show of hands, how many of you guys refied a home, bought a car, maybe bought a home prior to 2 years ago? Right? You probably got a great rate, right, Kelly? 3%, right? I refied a bunch of properties too at about 2 3/4. But I also bought a home last year at 7.1%. So much like it's advantageous to buy a car, a home, refi a home in a low interest rate environment, it's the opposite for investing with an insurance company. You see, as an insurance company, when we have access to really great risk-free rates, we can pad all of our investments and our risk and our back book and make things really attractive. So the best time to buy an insurance product is when rates are high. And right now is the best time to be looking at an insurance product. But I warn you, it won't be forever. As soon as the Fed starts cutting rates, insurance companies will be forced to pull back. So not only can we provide you with these great incentives at very low cost and provide you with a personal pension, but we're also building in long-term care. So in addition to getting your annuity that has downside protection, equity exposure, and lifetime income, if you or your loved one has a long-term care need, we can supply additional cash flow to cover those expenses without having to make you go through underwriting, no uncomfortable conversations or a physical, and everybody gets an approval. So I'll finish it with that. Just know a couple different takeaways. You no longer have to buy a fixed annuity, a fixed index, or a variable annuity. You can get it all into one. Kelly has the ability to buffer out losses each year and determine what's most ideal for your portfolio. And if your portfolio needs lifetime income, she can bolt that in. In addition, if you want long-term care coverage at no additional cost and without having for you to qualify, she can bolt that into your insurance contract. All right. So ladies and gentlemen, big thank you for your time and your focus. I'll let Kelly address any questions that you have.
Okay, thank you, Chris. Right there. So, did you have some questions over there? Okay, the one thing I did want Chris to go over a little bit is a lot of the, and maybe it's too detailed, you have to tell me, but a lot of the illustrations that I do for folks that show income for life, his pension he mentioned, which a lot of people really love that income for life. It goes up every year that you wait to take it. So it might start at 6%, but if you wait another year or two, it might go up to 6.5, 7, 8%. It really, you want to go over that a little bit?
Yeah, may I use the whiteboard?
Sure.
I know it's
Yeah, let me
small,
step
but
out of the way.
I'll do my best.
Yeah, sorry about that. Our technical difficulties are stopping us from doing kind of what we wanted to do today, but that's okay. You can,
All right, I'll
maybe
do it.
it's-
Hi.
there you go.
So let's take a client. Let's use James, for example. He's age 60. And let's say James wants. I don't know if they can see it. Let's say James wants income now off his portfolio. As an insurance company, if he's got $100,000, we can guarantee 6%. So $6,000, worst case scenario will be flowing into his portfolio. He can spend it, he can save it. It's there for him to cover his essential income needs. But every year James waits, I'm going to add 50 basis points. So we'll do this. Let's do this. So I'm going to add 0.50 to his income every year he waits. So assuming James waits 3 years, that means we've got 1.5% added to his 6%. So that's 7.5% just by waiting 3 years. So while James is waiting, we can buffer out his losses, we can maintain his equity exposure, tilt his portfolio to growth, but every year he waits to pull income, I'll reward him with more guaranteed income for life. Does that make sense? Mathematically, we want to enable the investor to pull a higher percent off of a lower number than rely on a big number, only allowing a small percentage. Right? So the annuity is allowing you to use less cash and generate more income in your portfolio to cover those essential income needs.
Okay, wait, you have to write, if you have a question, write it on the page. So, because people on Zoom can't hear you. So have Faye write it for you. Okay, if you could be really quick, go ahead, David. Okay, the optimum number of years to wait and to do that scenario here to create more income for yourself.
Yeah, so let me answer that. So remember the math. If I'm going to give you 8% a year, it's going to take 12 years to get all your money back. Okay. So if we're age 75 and we start pulling that on, we got to live past life expectancy for you to get all your money back. The goal is to get all your money back and to beat the insurance company. Remember, we want to beat the insurance company. So we don't want to take it too late. Get even with the insurance company. Thank you. Basically, what it means is we want to get as much of our money back, our gains back, and every year we live off the insurance company. But if we only get 5%, that means we got to live 20 years just to beat the insurance company. If we've got an 8% withdrawal rate, that's 12 years. 10% withdrawal rate, we just got to live 10 years, right? So we don't want to wait too late. We do want to pull a little bit earlier, but it also depends on how it works with your other sources of guaranteed income, including your pension and your Social Security.
Yeah, and that speaks to me doing the whole financial plan for you on all of your assets, because you're going to have Social Security as an income. You're going to have a rental property. You're going to have different things that are creating income for you. So this is part of the whole scenario here. I did have a question come in. What's the minimum to invest in the Allianz variable annuity?
All right. We're a $3 trillion insurance company. We've established ourselves in 1896. We've been around for a long time. We're a global name, so we don't need a lot to do. So we don't need we only need a little to do a lot for you. The minimum is $10,000 to enter into the investment. The max is 10 million.
Maximum 10 million. Okay.
Yeah, and we do see a significant amount of those policies.
Okay, and then what does this cost? What's the cost for this?
Well, the more you pay, the better the upside that you get. So we currently have a no fee contract where there's no expenses or charges. It's a basic run of the mill where you've got all your buffers and your upside. Now, if you are willing to pay a fee, the fee is 1.25%. So what that allows you to do is we can still buffer out the losses, but what we have is enhanced participation rates. For example, we have a participation rate of 130. So whatever the S&P does, Allianz is going to add an additional 30% in returns. So sometimes if you're an investor who saw your portfolio pull back significantly in 2022 and you want to get those gains back, paying the fee is worth every single penny.
Yeah, I think that's important to know because a lot of annuities I see when people bring me old annuities, and by the way, if you have an old annuity and it hasn't performed particularly well, let me look at it. Maybe we can do a new annuity for you, like in the Allianz variable annuity here, that will increase your income, increase your death benefit, increase the income that it can have. Because a lot of annuities I see have caps on them, which means you can only make over, or you can only make up to 3 or maybe even 5%. I just had a client that's actually on the Zoom here today. We were talking about that. He had a cap on his annuity. Well, he's only going to make over, up to 5%. If the market goes up 10%, he's not going to make that. Only that first 5. So those old annuities that have that are really not the best kinds of annuities. I like these kind much better. So we can work with those and try and improve those for you if you have those. So again, having the diversification, having different income streams on different products, I think is really good. Again, I look at the annuities and a lot of times I see those caps, or I see they only have a 70% of the S&P 500. Chris just said, if you pay the fee, the 1.25, you get 130% of the S&P. Again, there's lots of bells and whistles here. We can tailor make this for you. So any other questions in the room real quick? Before we, we got one right here. Let me see what we got here. Are you affiliated with Allianz Insurance?
Yeah, so Allianz being a $3 trillion global brand has many different silos. And there's Allianz Annuities, Allianz Insurance, that includes life insurance. That's also. Yes, thank you. So many of you, if you've ever booked a trip on Expedia, there's this last little option that says, would you like to insure your trip? Allianz does that as well. So we're broadly diversified. I happen to represent Allianz Annuities.
Okay. Well, thank you, Chris. Thank you so much for coming.
Thank you, everybody. Thank you, Kelly.
I thank you. Okay, so I have a few more slides to go through here. Let me, Anthony, help me out, get to the next slides here so I can end with everybody. There we go. Okay, so like I said earlier, we do have a lot of upcoming seminars coming. Those of you in the room, you have those on your table. Check the website here, CaliforniaWealthAdvisors.com. We'll show you what other webinars we have. We'll fix our video things here sometime soon. Excuse me. Also, those of you in the room, please fill out my evaluation form. I will have some prizes to hand out to you, that those of you turn these in to me. Those of you on the Zoom here today, we will be sending you an evaluation form so you can give us your feedback. Your feedback is very valuable to us. I know that the video didn't work so great today, and I do apologize for that. We'll get that fixed. But if you couldn't hear us or the information was great and you really appreciated it, we like to hear that too. So anything you can give us would be great. Again, if you're new to me, I like that first meeting to meet with you, to be in person. I prefer to be either in my Anaheim office or my Santa Barbara office. I want to get to know you. I want you to get to know me. I can do Zoom meetings as well as Zoom calls. So we have availability for new clients that want to meet with us. So again, thank you, everyone. I appreciate that. Everybody in the room here, everybody on Zoom, very much appreciate you being here, and look for that next webinar and in-person meeting we're going to have. I think it'll be real educational for you as well. So thank you so much. Appreciate all your time.